The Reserve Bank today probably surprised the market with its hawkishness. Yes, it didn't change the repo rate or its stance as expected, but given that the US Federal Reserve is now expected to cut rates by 125 basis points in 2024 versus only a 25 basis point expectation during the June policy, some in the market expected Reserve Bank to sound a tad dovish. On the contrary, there were signs of hawkishness in the statement and in the press conference. The CPI forecast, inflation forecast for the current July, August, September quarter has been upped to 4.4% from 3.8% earlier. That is one sign. The second, the Reserve Bank has forecast inflation for the first quarter of FY26 next year at 4.4%, whereas in the MPR, the Monetary Policy Report in April, they had forecast it at 4%. That is the CPI for FY26. So, is the RBI correctly cautious, rightly cautious, or is it overcautious? What about its other warnings on poor deposit growth, on top-ups on home loans? To answer all these questions, I have with me an elite panel. I have Mr. Dinesh Khara, the chairman of State Bank. He's joining in just a bit. We are also joined by Mridul Sagar, who is professor at IIM Kozhikode, but a former member of the Monetary Policy Committee and ex-RBI ED. B. Prasanna is the head of Global Markets Group at ICICI Bank, and Samiran Chakraborty, Chief Economist, Citi, India. Gentlemen, thank you very much indeed for your time. First, this doubt I have. The expectation was that maybe, some wriggle room they will make for themselves in case they have to, cut in December or earlier. Mridul, what could have been the thinking of the Reserve Bank? Why didn't they allow themselves that wriggle room?
Latha, I think the biggest problem which a central bank faces is that if it indicates that if there is a shift in conditions, they might pivot, then they will prematurely ease financial conditions. If you see data hard, I think the banks have already lowered the lending rate instead of raising the lending rate over the past 2 months on the fresh deposits. That's the RBI data which says. On the deposit side, they have not lowered, just 2 basis point fall is there in 2 months. But on lending side, there has been fall. So if you give a signal, then probably the deposit rates would ease at a time where there's already a huge issue about the mismatch of credit and deposit ratios. So the incremental credit deposit ratio being pretty high and including the investment number. So banks are growing at 128% roughly of the deposit growth. So there is this liquidity angle which the governor hinted at, and which I had also mentioned in media around a week back about the financial stability risk emanating from it. So I think that's what is keeping Reserve Bank on cautious. And inflation has risen to 5+, whereas the target is 4. So it's very difficult to sort of signal. If the pivot comes later, it would be when already sort of we see hard numbers that the growth is getting affected, which is not the case as of now.
Okay. Yeah, which is what the governor also pointed out, that we still don't have any clear evidence of a US slowdown. But Mr. Khara, welcome to the show. Thank you very much for your time. This is a very important point that Mridul just made, if you heard him, that actually banks' loan rates have gone down a bit in the past few weeks, although there is a war out there for deposits. Can you explain? This seems to have, impressed on the Reserve Bank as well. How do you drop lending rates when actually your deposit costs are clearly going up?
I fully agree with you, and that is something which you have seen. So actually what has happened is that there is a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill, and today the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. So this is the kind of a market where we are all operating today. So some of the loans are linked to MCLR, some of the loans are linked to T-bill, and it depends on the bank and the kind of interest rate benchmark which they are following. So much of it is actually guided by that. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various sub-segments in the market, and they're all getting priced differently. So that is something which is a reality.
I agree, sir. I mean, there are several markets out there. But would you say that as a consequence of several factors, you know, the LCR rule, the bond index inclusion, we are going to see market yields go down, but because of, you know, the dearth of deposits, deposit rates will go up. Are we therefore going to see bank margins getting compressed, as also borrowers moving to the market and not taking loans?
See, not all borrowers can move to market. This is a reality which cannot be ignored. And also not for every kind of facility they can move to the market. So I think even market has got its limitation in terms of their capability to absorb such kind of business opportunities. So I think we'll have to probably wait and watch. This is a point of time when we are at a cusp of various evolutions, and we'll have to probably wait and watch and see that how really things stabilize in the days to come. But yes, of course, at this point of time, you know, each of the players is playing according to the opportunity which is available in the market.
Okay. A final question to finish this theme. Mr. Khara, do you think that loan bank credit growth will taper down to meet the deposit rate? I mean, if the deposit growth, for instance, for SBI is 8.8 and loan growth is at 12 or 13%, sooner or later, even for the industry, loan growths have to taper down, isn't it?
See, again, here it will depend. If at all there are opportunities for in the loan market to fund this kind of a growth, bank will have to think in terms of at what rate they can raise the resources. Okay. See, for instance, I would like to draw your attention to the fact that way back in 2004, 5, 6 also, we had seen a situation like this, where the deposit growth was much lower than the loan book growth. Those are the point of time when CD market actually evolved quite a lot. So again, now we have seen that, you know, infrastructure bonds are becoming popular. CD market is becoming popular. If at all there are opportunities to lend and the kind of risk which the banks would like to lend, I'm sure they will be in a position to raise the deposits. It's not that deposits are not available, but the price at which they are available, will that be something which banks would like to look at it? That is something which has to be kept in mind.
Got that, sir. I'll come back to you for the other points that he made on top-up loans. But let me finish the economic arguments. Samiran, what is your sense, given the macroeconomic data that we have, the evolving circumstances globally, when would you position the RBI changing its stance and stance and rate action?
Thanks, Latha. I guess what is coming out of the RBI communique is that RBI is definitely have an unwavering commitment towards getting inflation down to the 4% medium-term target. What is helping RBI is twofold. One is that the domestic growth numbers are coming out to be quite robust and resilient. And second is that if you look at the overall financial conditions, which includes banking system liquidity, equity markets, credit markets, FX markets, and put it into one index, that overall financial condition index is still on the so-called easy territory. And that's why RBI does not need to cut interest rates very aggressively to support growth. And the last point I would make is that if you look at how the global situation is evolving, there is just so much uncertainty that it's very difficult for any central bank to be proactively taking interest rate calls on the basis of that. So given where our current growth and inflation forecasts are, we think that the first rate cut could be deferred till April 2025. Maybe the stance change happens just a little before that. But as of now, there is no urgency that is there with the RBI to tinker with rates. And as the governor has always maintained that for orderly evolution of financial markets, a stable and predictable policy regime is what is warranted. And the RBI is delivering on that front.
I take your point. Actually, the RBI very cleverly did not hike rates but made liquidity tight last July when inflation numbers came in at 7.8, and they have effectively given a rate cut by bringing back the liquidity, so to speak. So the call rate has clearly gone down from 6.75 to 6.5. So that perhaps would count as a rate cut, a stealth one. Prasanna, do you think that the Reserve Bank was actually defending the currency?
Well, that's an interesting question, Latha, but I mean, you can never tell what really goes in the minds, but it's quite a possibility. And yes, they have been a little bit more, I mean, first of all, I don't think too many people expected them to be dovish, but we all thought maybe he will give into a little bit of dovishness in the post-policy conference. But even that did not come through. But yes, it's quite possible, but I don't think there is a real direct linkage between the way INR will behave or the currency will behave and the kind of stance the RBI is taking. Actually, the RBI has been quite hawkish for all this time, and hence the focus on inflation, like Samiran was saying, has been quite pronounced. So to that extent, it's just a continuation of what they have been doing earlier. And I will just refer to a statement that he made in actually an interview with you, Latha, where he said that giving guidance is something that he doesn't want to do. So when there is just one set of data which has come from the US, which is seemingly indicating that there is a much bigger slowdown than what you are what markets were expecting earlier, he probably wants to see a little bit more data before he gives in to even a change in stance. So my feeling is that he'll probably think about the stance change in the December policy. That is because he would have had a couple of policies from the Fed by that time where there would have been a couple of cuts priced into the market. So I think we'll have to wait and see. At the way in which they are talking, we can't see a rate cut happening anytime soon. But I do feel that at some point of time, the emphasis will shift to growth, which is when they will really start talking about a stance change and a rate cut.
Okay. A final question before I take a break. Mridul, I mean, no one can tell the future really, but what are the chances that the Reserve Bank could be making the mistake it made in February of 2022? You were there. If you remember, at that time, the Reserve Bank had spoken dovish, very dovish, 4.5% inflation forecast, and then comes the Ukraine war, and all hell breaks loose. So many hikes after that. Inflation changes. Now we are getting a smell of the global economy, the way it may pan out. We don't know. If indeed 125 basis points cut were to come, will this policy be remembered as possibly a policy mistake?
There is a small possibility of that. But the point is, in this policy, it was difficult to put it in the baseline because clearly, though equities had corrected big time, I mean, especially the Nikkei falling around 11% from mid-July, S&P around 7.5%, Indian stocks less, roughly 3%, and so. But these would obviously start changing from the financial accelerators it will generate. Probably it will slow down the global growth unless Fed pivots a big way. And that might be difficult for Fed to do at this juncture. So if global growth slowdowns, India cannot be decoupled with that. And there will be some effect to the 7.2 growth forecast the central bank has. I'm not sure it will fall as much as 6.5, which the economic survey says, which to my mind was rather a number which supported a fiscal GFD to GDP ratio, which looked more credible at the number there of 4.8, which was put in the budget for 4.9. If you assume a nominal GDP growth of 11.5%, this number could have been 4.4%. So the nominal GDP projections of the government were a big constraint in the growth numbers. So I see it would be somewhere averaging between the RBI forecast and the government forecast. And there will be some pressures coming down later in the year or early next year for RBI to start changing the stance and give a notional rate cut. But let us be mindful of the fact that RBI is just around neutral. RBI has never tightened in this monetary cycle. So if your neutral rate is what RBI has indicated, then you are at the neutral. Whereas Fed has raised it to 525 basis point, and therefore they have a room to cut. RBI doesn't have a room to cut.
That's absolutely right. For all you know, Reserve Bank is going to have the last laugh, and this question, is superfluous. And as Samiran and Mr. Khara have pointed out already, it's not that the conditions were tight in the first place. Okay, I'll have to take a very quick break. Coming back to check with all of you what will be the movements in the bond market and your analysis of the economy as well, and the important statements the governor made on this top-up loans. Coming back in a minute.